Welcome to the Brick by Brick podcast. I'm Ben, and I'm here with John and Ryan. For today's episode, we're going to discuss the geographic area of choice for most investors when they're first deciding where they want to make their first real estate investment. We're going to talk about markets and submarkets, timing of purchases, and how to source those deals, and the process itself of narrowing down your search as an individual investor. Begin to decide where it is you want to allocate your capital, both for your first investment, for intermediary investments, and for future investments. So guys, let's jump right into it. Maybe we can talk a little bit about our own processes and how we got into the first markets we found and what drew us to those markets. I think that might be a good place to start. Ryan, you want to take a crack at it?
Sure. The way that I break down this discussion is starting at the top. We're looking at things on a market level, and then beneath that, you begin to consider the submarket. And then beneath that, you have different neighborhoods or other areas within that submarket. So when I was making my investment decisions locally, or at least most recently, what I was originally contemplating was which market I wanted to be in, which for me was an easy decision because I was pretty limited in that I wanted to do it close to where I was geographically located. And beyond that, I was looking at a variety of factors, such as the entry point on a purchase, which limited me, or at least precluded me from buying in, let's say, an area like Manhattan. And then lastly, I was looking for neighborhoods that kind of struck a balance between something that had a little bit of a positive outlook moving forward, but that wasn't so saturated, it wasn't so competitive nowadays, that I felt like where I felt future opportunity or future values had kind of passed me by.
Yeah, I think where to invest is a broad topic. And the way that I got started was just, I mean, if you listened to the podcast before, my investing story is like I just wanted to buy a place near where I was already living. So, I was living in Manhattan and I wanted to buy a place in the greater New York City area. So I bought a place in New Jersey, which was the closest affordable place at the time to where I was living. But the factors that go into where you want to invest, I think, depend a little bit on your investment thesis. So maybe we can get in a little bit to that. I think from a very high level, the easiest way to say where I want to invest is I want to invest in a place that makes me the greatest returns, but that may not exactly be the greatest returns monetarily, may not be correlated with your goals in doing real estate investing. So for example, if you can make great returns in a city very, very far away from where you live, that might be nice. But if you want to get into doing investing, say full time, or you want to be a real operator, totally outsourcing your investments to a third party in a different city is not going to fulfill the goals that you have of being a real estate operator. I know Ryan actually started investing not locally, right? Your first deal was in Nashville, is that right?
Memphis.
Turnkey.
I wish it was in Nashville.
So close.
I think I would have appreciated quite a bit more than Memphis did.
It was a turnkey investment, right?
It was. It was a
construction on it.
Yeah, it was a single family. Purchased it for right around $50,000 and rented for like $675 a month.
How did you find that?
So that was back when I was wrapping up college. My brother and I were looking for a turnkey investment to get something under our belts, and we had kind of perused a few different markets outside of New York because we were a little bit more capital constrained. And
what is peruse exactly?
Perused? We browsed.
No, I mean, like, how did you browse?
This is why the geography map placed them in New Jersey, because if you're outside of New Jersey, you don't use the word peruse.
No. I mean, how did you peruse?
I know. I'm just
so at the time. Well, we were first and foremost looking for something or for an area where we could buy a single family house for under $100K and be looking at rents that were, obviously able to support the investment and yield a decent return, but also to know that we're not buying in what we would have considered a war zone or an area where we wouldn't have really felt comfortable owning property, especially remotely. So I think at the time we were looking at Memphis. I think we had briefly considered some areas of Atlanta. I think either Dallas or Houston, there were some providers over there that we had explored very briefly. But ultimately, Memphis was the first one that it seemed to tick all the boxes. It was also easy to get to, which for us was kind of important because we figured if our manager wasn't holding up their end of the bargain and we had to physically go there, we wanted somewhere where it wasn't going to cost us $1,000 to take a round trip flight to go for 2 days just to make sure that the house wasn't on fire.
Yeah, it's funny you guys mention both the geography and familiarity with certain areas, because I know while I am not as far in my career as either of you, what brought me to Ryan first and then John was the fact that I had an interest in college and was seeking in college my first investments, particularly in the Hudson County area across the water, in West New York, in Union City, in North Bergen. And the reason for that was twofold. One of them was that the market was strong. There was consistent rental growth and sales growth over a certain period of time, which I was tracking and was excited about as an investor. But there was also a familiarity factor in the sense that the person and partner that I was planning on going into this business with had family and friends who had been contractors in the area for many years. And so I understood that I was going in for myself, looking at the market and having a familiarity with how to source deals and underwrite deals, but had a partner who had experience with construction and understanding how much things cost. So I think it's probably important to also think about who do you know in certain areas? I mean, it's natural to want to invest, I think, close by. And if the numbers can work for you, then what are the other mitigating factors that might bring you closer to pulling the trigger on a deal in that neighborhood, or maybe making you look a little bit further away?
Well, yeah, I think really high level, the way that I think about geography. So a lot of times when I look at an area, I'm looking at it for buy and hold purposes. At least that's how I've been traditionally doing it. I think for flips, it's a little bit different. We can talk about that. But for a buy and hold area, I like to come up with a thesis for investing in that area. Mm-hmm. And if I don't have a thesis that I feel comfortable with, or if I can't think of one, then that's probably a bad sign. So, the greatest example for me is the tri-state area, like the New York City suburbs. So the thesis for investing in New York or in New Jersey or in Connecticut, anywhere around New York City, is New York City. So obviously not everybody who lives in New Jersey or Connecticut or even New York works in New York City, but the reason why this region is what it is because of New York at some point. And the reason why it's going to be sustained is because of New York. So when you're buying real estate around New York City, you're betting on, in a sense, in New York City. You're saying, do I think people are going to keep living in New York City, traveling, working, culture, whatever? And for me, the answer is yes. Some people might disagree about that, but probably a lot of people believe that New York City is going to be a great thing. We also invest in New Haven, Connecticut, which is a little bit of a different market, tertiary market, not a New York City suburb per se. But the reason why I invest in New Haven is because of Yale. So Yale has a ton of money. It owns a bunch of property in the area. And it has the second largest endowment of a university in the entire nation.
Here we go.
So investing in real estate in New Haven, particularly around Yale, is betting on Yale. And do I think that Yale is going to be a place where people want to go, that's going to have a lot of money, that's going to care about the city? Yes, I think that's a good answer. So you can take that analysis and say, well, what's my thesis for investing in a small city in Iowa? I don't know. Maybe the returns look great on paper, but I don't know why people live there.
Well, I think a good example of that is the way that you, John, identified, and now we as a group are identifying properties in Atlantic City, because I think what people would look at as mitigating factors to keep them away from the market, things like the environment. So obviously the fact that the city could be underwater, things like a generally I guess maybe you would say summer-oriented.
Literally underwater. And figuratively.
So a market that is more based on what they deliver in the summertime. So vacationers and people coming for maybe weekends or bachelor parties. Obviously, there's the casinos down there. And you found a model via Airbnb, which has generated returns well above, I think, what you would generally get at market rate when you're talking about traditional rentals. And so I like your description of the thesis you bring to the table, because that is a perfect example of looking at an area like Atlantic City that through traditional metrics, maybe you say, even if you live further away, I don't know about this, and turns that into, that's somewhere that I want to try to source deals and pick up things on the cheap.
You can also tease out your assumptions and your risk factors that way, right? So if you say, I'm going to invest in an area, and the only reason why people live in the area is because there is this one big thing, like there's a big manufacturing plant or there's this big type of industry, then your sensitivity is, well, if that industry or manufacturing plant or whatever closes, that's it. There's no other reason to live in the area. So I'm not saying that's a bad reason to invest somewhere, but it's helpful to have the knowledge of saying, here's what I'm sensitive to. And if any of those things happen, then it's going to be bad for me. And, Detroit is an example, right? So whatever, yeah.
Or another example of that today, quite timely, is Long Island City and Amazon HQ too.
Right.
There was a lot of hype and a lot of I think probably a lot of speculation that went on over the last few weeks, the last few months since HQ2 was announced for Long Island City. And, obviously the sensitivity there is a little bit different than it is in some other locations where you don't have such a diverse subset of industry. But nonetheless, I'm sure there was plenty of speculative work that was done in advance, either for redevelopments or for just people who thought, rents are going to go through the roof because people who are coming in are going to have quite a bit of money.
To piggyback off that real quick too, the L train I think is even a greater example because that was 2 years in the running and people signed new leases and moved businesses and sold homes. I had friends who were involved in the real estate business who were considering going in with partners and buying up homes along that area at a discount to market, given what everybody was anticipating. So it's a great point.
Or the Upper East Side of Manhattan, where you've had the 2nd Avenue subway in the works for, I think it's been
subway.
30, 40 years.
Oh, it's been since
it's really
World
like
War
60
II.
plus.
World War II.
But yes,
it finally came online over the last few years.
From 96 to 72. So it's getting there. So in another 80 years, maybe it'll have crossed
You'll have more
Midtown.
than 3 stops.
But it is amazing. And it does do a lot for congestion as well and for pricing along that line.
Right.
It's funny because when I was working for a property manager, actually, we used to rent 2 homes that were literally right on 2nd Avenue on 83rd Street, where the hub on 83rd was being built, and I hate to say this, I probably shouldn't put this on record, but we would probably strategically not bring people during the height of working hours because it's unconscionably loud. However, at the same time, people were then getting a discount to market. And frankly, if someone had come to us, given how delayed that process was, had come to my boss and offered a reasonable price, maybe a little bit discounted to market, I wouldn't be shocked if she would have maybe considered something like that given the circumstance. So it's all considerations to take under account.
And it's all from an investing standpoint, it's interesting to think about how many deals were consummated over the last 20, 30, 40 years with the assumption that this redevelopment was going to be a success because over the long term, that 2nd Avenue subway was going to be a boon to the area.
Yeah. And the thing about it is you can never truly anticipate what's going to happen in a market. Again, the HQ2 example is so great because now HQ2 is not happening in Long Island City, at least at the time of this recording. So you can never anticipate what's going to happen with the market, and that's okay. But I think it's important to at least have the knowledge of the factors that might implicate it. So even if you can't control them and don't know what's going to happen, it's at least a modicum of control to have knowledge of what the factors are. So for me, the first step in thinking about an area to invest in is the thesis. Can I come up with a thesis that I feel comfortable with? Is there a reason why it's going to happen? And then along to dovetail with that, something that we brought up earlier for me is, what is my goal in investing? Is my goal to maximize the amount of money that I'm investing? Is my goal to learn about investing? Is my goal to make this one of many projects, to buy only this type of asset, to buy different types of assets, to do buy and hold stuff, to do flip stuff? And that depends on you. My goal getting started in real estate was to do more real estate investing. And for me, that meant it was conducive to invest near where I was, because if I was investing on the other side of the country, even if I wanted to do a lot of that, just physically getting there would be very, very hard. And it would take me a long time to ramp up, because even if I got comfortable with an area, I would have to get very, very, very comfortable offsourcing all of that work to a third party living in, wherever it might be, before I really got started. Whereas living in New York and investing in New Jersey as I started, that's a 15, 20-minute trip over that I can do at any time, and did many, many times before I moved here.
There's also some calculus involved with what your risk tolerance is, because the Amazon HQ2 example highlights the resiliency of the New York market, where frankly, that's probably not going to make much of a ding in the economic viability of those areas. But if you're talking about an area if you're talking about, like a one manufacturing plant town in rural Pennsylvania, and your investing thesis is that there are 5,000 jobs in that specific area that are tied to that plant, the moment that plant shuts, there are going to be very few things to pick up the slack for it.
Yeah.
And so the risk is it's truly, boom bust. It's either it's going to go well because you have that, or you're going to be, there's going to be no suitors for your property as tenants, and there will probably be very few end buyers should you decide to liquidate.
Yeah, it's one of the things that annoys me about, sometimes I'll encounter people and they'll be like, oh man, I'm making a killing investing in city I've never heard of in state that is, among the 10 least populated states in the country. And it's like, well, maybe. I mean, maybe the returns are great, but why do people live there? Like what's going on in that area? I don't say that cynically because maybe there is some reason that I just don't fully understand. But I bet that you could find a multifamily property in small town, small state that's going to look great on paper. But what's going to happen to that property in 2, 5, 10 years? I have no idea. I'm probably not familiar with that market enough, nor can I come up with a thesis as to why it's going to do well. So that's a pretty risky investment to me, even if the numbers might bear out as being very conservative.
To what extent, this is kind of shifting gears a little bit, but John, to what extent, if you have vetted a particular market, let's say you're talking about New Haven, to what extent do you try to validate some of your assumptions with data? Do you get into some of the demographic data? Do you get into average incomes? Do you look at home prices? What's your next step?
I haven't really looked at demographic data per se. What I'm most interested in would be the rents versus price of homes for a buy and hold. So that information is extremely readily available. It's literally going on Zillow or anything, looking at what homes are, and then going on Craigslist or Rentometer or any of these other websites and seeing what the average rents are. That alone is a pretty good starting point. I think crime data is very helpful. I think crime is probably one of the prerequisites to a lot of, you can have great returns on paper, but if you can't walk outside your door, nobody's going to live there. There's a big distinction in my mind between what the returns could be on paper and what they actually are. A lot of areas that have bad crime, you look at whatever analytical model you want to look at, cap rate, cash on cash return, IRR, whatever, and you say, oh my gosh, it's so great. Even if you assume vacancy of 10% or whatever, and then you go in and it's insane because you just can't get anybody to live there. Your vacancy is like 50% or 80% or whatever you want to say.
It's funny you mention that because I have a theory that oftentimes the best deals, the best returns that you can actually realize fall at that intersection between the areas where people have these preconceptions about maybe there being too much crime or it just being undesirable for one reason or another, so that it scares out a certain class of person. But at the same time, the reality is once you investigate it, there are still plenty of people who do live there, and the perception of crime perhaps is overblown.
Right.
And so I think that's really where you can maximize returns, and that's where that kind of artistic or subjective metric of intuition comes into play, where you actually go somewhere and you see it and you understand what the living, breathing fabric of that society or neighborhood is.
A concrete example, and so I started investing in Union City, New Jersey, and I think Union City and Jersey City as well very much have fit that thesis. So even now there's a perception in parts of Jersey City, but certainly 5-10 years ago in many parts of Jersey City and Union City that the area was dangerous and unsafe, and it certainly was in the 90s. But if you physically go to the area, if you walk around and you talk to people and you say, do you like living here? Do your kids like living here? Have you ever experienced bad crime? Whatever. No one says anything at all. If you look at the news reports, there's maybe domestic issues or maybe small property crime type stuff, but not anything that would really disincentivize someone to live there. But there's this widespread perception that the area is not good. And to your point, absolutely, you can make a killing.
We've also talked about this in the context of comparing certain cities that have the reputation for being kind of the worst of the worst. But even within that classification, there are big differences. I think we were talking about it with some of the cities up here where people around here may say, what are you doing buying in so-and-so town or so-and-so city? But when we go there, we feel pretty comfortable during the day. There's people coming to and from work, people just kind of hanging around talking, and no hostility, no obvious signs of threats really.
Yeah.
But there are other places where we've been where you go and you'll go 2 or 3 blocks and all you see are vacant, abandoned houses and just the absence of life, which is perhaps the scariest thing.
Yeah.
And as far as that concerns an actual investment, my theory with a lot of these places up here is that while there are certain tiers of desirability, at the end of the day, there's a shortage of housing and people want to live where there's safe, clean, quiet, comfortable place to live. And if you can provide them with that, even if it might not be an area where you personally would live, that doesn't mean there aren't plenty of reasonable, nice, qualified people who will live there.
And I think it's an important point too, because you want to try to fight your own biases as you look at these different areas. So I think it's very easy to fall into this sort of ideal, especially if you're coming from outside of the real estate business, that somebody says something about maybe Irvington or East Orange, both places that we're either invested in or doing work in. And you just say, oh yeah, why would I go there? Or what could possibly be there? And then when you put your boots on the ground, you learn that there's actually opportunity, whether it be in construction or investment. And I think that just the other day, I was talking to friends who were from the Summit, New Jersey area, describing work we were doing in some of those municipalities, and they were stunned. I mean, they were flabbergasted. Irvington, what are you doing there? Obviously, there are different areas that have different levels of crime, what have you, in all these different cities and townships. But fundamentally, if you build, as Ryan just alluded to, safe, good, fundamentally sound homes there, people will come, especially as these towns and areas begin to get younger over time. I think you'll see, generally speaking, a shift in all of these different areas because at one point or another, they did thrive.
Yeah, I think it's a great point. So something that occurs to me is a lot of what we're talking about is very specific to the Northeast, and I don't want to gloss over there are listeners who are not from the Northeast, and I think it's hard to describe exactly how block by block a lot of these neighborhoods are. So kind of within that observation is, to go back to Ryan's first point, something that I really like to look at when I'm looking at cities or blocks or whatever it might be, is the build quality of homes, because a lot of these homes, we're not buying new construction in this area. These homes were built 40, 50, 60, 100 plus years ago. And by looking at the homes, you can say, well, this area used to be very wealthy, or this area was never particularly wealthy, or this, unwealthy area now has become wealthy for some reason. So one good example for me is East Orange. East Orange is an area in New Jersey that has I would say, quite negative perception just in terms of housing and demographics and crime and whatever else you want to say, educational system. And definitely it has some problems. However, the build quality of a lot of homes in East Orange is quite nice. And there are some areas of East Orange where you look at homes that are on a half an acre of land, which for this area is a huge lot. And you say, well, this is a beautiful home. I mean, beautiful original woodwork that you could just never reproduce today, never would reproduce today. And that gives you some sense to say, well, this area at one time was wealthy. Maybe it could be wealthy again. What are the reasons why it became unwealthy? How does that work? And truly, I could walk 3 blocks, literal blocks in any direction from that and be in a totally different area. I mean, where I live right now, where I'm physically located right now, literally, I could throw a stone across a river and go into an area that is totally demographically, economically, socially, educationally different than where I'm living. That's pretty rare and should inform people that want to invest in areas like this to say, I need to do my homework to figure out not only the city, not only the neighborhood, but the block that I'm interested in investing in.
Yeah, I mean, listen, we just had that happen with also a property. This is a little bit of a different area on the border of Nutley and Clifton. And talking about, okay, on a macro level, right, you want to just know what's the neighborhood like. So we've talked about crime, we've talked about education, and we've talked about socioeconomic and cultural history of the area. But also within that is, okay, so what is the designation? So being in different counties means you might be designated for different public schools and different zones. So these are the kinds of things, obviously, different costs affiliated with maintenance and what have you based on the history of the area and the build of the homes in the area. So these are all things that you have to consider. And I know when I'm looking at comps, even in these areas, and I'm used to growing up in New York City where truly, I mean, it's not even just block by block, it's lot by lot, it's building by building, the values change. Coming to New Jersey, where the lot sizes tend to be a little bit smaller probably on aggregate than the rest of the country, it's still the same way in many respects. And looking at Garfield the other day, I mean, I was looking near the water, I think on River Drive. And again, in certain areas, lot by lot, I see sales of similar like properties at the same square footage with similar lot sizes going variant ranges of $100,000 to $150,000. So do your due diligence on the specific area, the specific building, the specific lot. I think John hits the nail on the head with that one.
And if you're going outside of what you know, if you're investing remotely and looking at an area where maybe you didn't grow up or maybe you don't currently live, it's also important to take into account some other factors that may be variable depending on the region. So, for example, in northern New Jersey, it's very common that when you buy a house, you'll do an oil tank sweep and confirm that there is not an oil tank on the property.
An underground oil tank.
Underground. Yeah. Or oftentimes you may see them in the basement too, but of bigger concern is the underground variety. But if you're investing from somewhere where that fuel source was never prevalent, you would never even think to call someone out to do a tank sweep. Likewise, if you're in New Jersey and you're looking to buy something in Florida, you're going to be thinking about hurricane preparedness and whether it is like hurricane compliant. Likewise, in California, you're going to be taking into account certain seismic issues and concerns. So there are a lot of nuances to different areas that you should at least know to be aware of or know to ask about if you are investing from out of town.
What do you guys think about school districts? Because that's something that people talk to me about a lot, and I have various thoughts on it. New Jersey has a lot of school districts because they're municipality by municipality, which in some states it's not the case. But what do you guys think about the value, importance of that?
I mean, it's huge. I think the way that I think about it is quite possibly the most important factor that a particular subset of buyers will consider when making their housing decision. But in a lot of ways, I also think that the respectability or the clout of a school district is already embedded in the price of real estate in that area. So just because I'm looking at one property in one school district and another property in another school district that are priced the same, I'm not immediately going to say I'm going to buy the one in the better school district. There may be other reasons why someone would live in an area that has a less desirable school district. You may be renting to primarily seniors, or you may be looking at something in a vacation community where schools just don't matter as much. So I think it's certainly a factor, and it's one that I would weigh considerably, but it also has to be consistent with what your strategy is.
The funny thing about school districts is that it's the perception of the school district that cares, right? No, there's no like definitive rating of like, this is the absolute number one best school district in the state or whatever. It's just your perception of it, if it's a good school district, right? Yeah. So but for me, because it's a perception thing, I think that school districts are the best insulator of value, positive or negative. If you have a bad school district and you're trying to make the area better, I think that's going to be really hard, because this is far afield from real estate, but I think that it's hard to change the quality of a school district. And if you're in a good school district or perceived good school district, your value is going to maintain that level, because for better or for worse, people are going to continue to perceive that school district as being good.
Yeah, I have 2 points to make from different ends of the spectrum. On the pro side of why to invest in an area with a good school district, no matter what the market is, no matter what point in the economic cycle we're at, if you're a young family with kids who are entering who are turning 4, 5, 6 years old and looking to be or going to school soon, they're going to be interested in areas with good school districts, and that is going to be more of a guiding light than whether they're buying at the best time or whether this particular property ticks every box on their checklist. On the flip side, to my point earlier about considering school districts in the context of what your investing strategy is, if you look at an area like Jersey City or Hoboken, years ago, those were not desirable school districts whatsoever. And I think to a large extent, at least based on what their property values are, they are still quite poor school districts. But what drove development in those towns was the demographic changes of getting very, very young and catering to a class of people that are not necessarily concerned with school districts because they're only living there in their years prior to having kids, school-age children.
Yeah. I mean, I think it's worth noting where Jersey City and Hoboken, as good examples, are concerned, is that they're in spillover areas, though, as well. So, when we're already constantly weighing all these different factors. And I think that's a perfect example of where a lesser school district isn't going to deter you from a certain neighborhood. But I think it's worth noting for new investors or even intermediate investors that when you're looking at these areas, John talked about right at the beginning of this episode, the resiliency of the tri-state area and a lot of why that makes everywhere around this very appealing. And I think that if you're identifying an area just outside a city, oftentimes your bias is going to take you towards thinking, well, look what happened to Long Island City or is happening to Long Island City. Look at what's happened to Jersey City. And you'll extrapolate and say, that's going to happen in my area. And just to be careful about that. So to look at the school districts, for example, if you're looking at a spillover area in a really good city, if the school district is bad, now seeing some of these other areas, doing your due diligence of like-kind cities, areas, municipalities, townships, you might be more inclined to take the leap and looking at an investment like that.
I want to frame this too by saying it is the case that there are areas that are not only are they not getting better, but they're getting worse. And I think we maybe look at real estate a little bit like we being the three of us with rose-colored glasses because we've been investing in the longest kind of bull market that has been in a very long time for real estate specifically. But there are, not to pick on Newark, but Newark is a city, many parts of Newark have been economically depressed since the 60s and are still that way. And I bet you could go back to 1965 and talk to somebody and be like, you know what, it's going to be in 5-10 years, the city's coming back. We're doing this, doing that. And I don't know. I don't know what's going to happen in Newark in 5 or 10 years. Certainly some areas of Newark have gotten better, but I would say some areas have stayed the same, or maybe even gotten worse. So it's okay to come to the conclusion that, look, statistically, Connecticut, people are leaving Connecticut. People are not moving to Connecticut anymore. So you could say, well, some areas of Connecticut, like I mentioned, New Haven, I have a thesis about, but Connecticut broadly, I don't really want to invest in a place where there's a net outflow of people. There's some reason why people are leaving Connecticut. Mm-hmm. And that concerns me. So it's okay to say, look, this is an area that isn't getting better. It might be getting worse for some reason. I have a thesis about why it might get worse. So, I don't know how you guys feel about that. But
well, I think this also comes back to just having an investment strategy and choosing a market based on what your strategy is. If you're banking on appreciation, I think it'd be quite unwise to look at a market where all of the demographic factors and shifts are trending in the wrong direction. I don't think it's wise to assume that your property value is going to skyrocket when when you're facing all of these headwinds. Having said that, if you're looking for an area where your primary goal is cash flow and you're making reasonable assumptions on what your vacancy is going to be, and you're not assuming 10% annual rent growth, which would be, pretty absurd in an area that isn't appreciating and isn't drawing new blood every year. It's a matter of being consistent with what your strategy is. If you're looking at an area that's going to appreciate over the long haul, you should have a thesis that is consistent with that, and you should have some data to back it up.
What do you feel about investing in college towns?
It's funny, John, because I was actually sent an article about this a couple of years ago. Even a buddy of mine who went to the Shack program with me, him and his
dad. Shack program at NYU.
At NYU,
that's a very prestigious program.
Notice how I pointedly do not name the school. No, I'm just joking. I love NYU. Love that school.
Then
Go Shack.
New York University.
I bleed purple and white, I think is the off color. I'm not really sure. Bobcats? Who knows?
When you go to all of
Look,
your
our football team's
games.
undefeated. That's all that matters because we don't have a football team. So it's interesting. So I got an article sent to me a couple of years ago by this buddy of mine and his dad, and they were very interested in this concept. And again, the theory goes, well, these school towns are young. They're generally thriving within the nucleus of where the school owns buildings. Generally speaking, if it's a good academic institution, they're going to look to eventually expand because they're all looking to bring profits up. So they need to bring in more people who can pay full tuition. So they'll expand outwards. And we see a little bit of that in New Haven. And it's been maybe slow and maybe not expanded as far as some people would think. But this is the question, because as I now know, having been introduced to the neighborhood to John, within a certain radius, that is true. The margins still work out for new and intermediate investors, but it hasn't come all the way, I think, within a margin, and when I say margin, I mean a geographic margin, that I think most people would have predicted, given the prestige and the academic successes that surround a school like Yale and the perception.
To me, no matter what your thesis is, it's almost impossible to accurately predict appreciation, because any appreciation that you are assuming, okay, let's say your thesis is Temple University is expanding here. That's going to catalyze the area and there's going to be a lot of growth. It's going to drive property values up. The other thing that can counteract that is if there are 30 other developers who have the same theory that you have, and they go snatch up all developable land and they build way in over excess of supply relative to what the increase in demand will support. So just because things are happening and things are trending in the right direction, in that scenario, you may actually see a decrease in property values.
Yeah.
So I think appreciation is always very difficult to predict. And I think it's foolish to make an investment solely based off of that thesis.
What do you think about, so I often have this problem, I think even recently we were talking about this, you and I, Ryan, where you'll look at an area and you'll just run the numbers and you'll see these returns, like monster returns, like 10% cap rate, et cetera, et cetera, et cetera. And sometimes I look at that and it's like, why don't I just buy everything in this city? Like why am I even bothering in other places where I'm not getting those returns? I can come up with reasons right now, like as to why I wouldn't, but I wonder how you guys feel about that if you've seen places like that.
Well, I mean, I think diversification is the name of the game. I think people talk about this term a lot, but to me, the first thought I have is Atlantic City is a perfect example. The returns that we see cash on cash, the cap rates, particularly for our model and our thesis in that area, is quite substantial. Of course, Hurricane Sandy.
Like everybody's going to start investing in life.
John is like, stop it right now. Well, I'm just so enthusiastic about it.
Also, keep in mind that a lot of these models that we're running are predicated on an Airbnb model, which is highly susceptible to regulatory risk.
Do we have to give a disclaimer? Listen, you go out, you try your best, see if you can do what we do.
Keep in mind, we are trained professionals under closed course. Don't even.
Well, the reason I bring this up, the reason I bring this up is
like a 90-degree angle right now.
The reason I bring this up is because I actually texted John about this the other day. I think there are rumors swirling that Newark is potentially clamping down on Airbnb. I don't know if you saw the article that I sent you because once again, John ignored me.
No, I didn't ignore you. In fact, I've been thinking about it constantly.
Yeah, that's the thing, Ryan. Is when you send emails, we are always thinking about them.
I'm not bitter. No, I'm not bitter.
Ignored means I just I just actively didn't respond.
Let me just say, because that was that sort of parlays to the point that I wanted to make. I hate to keep bringing up Atlantic City, but the reason I do that is look what happened in 2012. Hurricane Sandy hits, the entire area was ravaged and destroyed. It could happen where Atlantic City or Atlantic County completely clamps down on Airbnbs and throws the thesis out the window. So the idea is diversification. You want to be invested in a number of different areas with a number of different, hopefully successful theses, so that if in any scenario, the worst case risk factor occurs, you're hedging and you're able to continue to sustain positive net cash flow throughout your entire portfolio.
Yeah, I mean,
right. I mean, what other? I'd be curious to know your guys' reasons.
I think a lot of that. I think a lot of that is predicated on underwriting to an Airbnb context, which I would argue is not necessarily as much of a real estate play as it is a quote unquote business play. Because at the end of the day, your income is going to be driven by the fact that you are effectively running a hospitality business, despite what Airbnb will, Airbnb lobbyists will tell you.
What do you mean by that? Because to me, I understand the distinction you're making between it as a true real estate versus just generally business hospitality play. But like when I look at different areas, underwriting New Haven is different than underwriting Hudson County. It's different than underwriting Bergen County. And so still diversification is diversification.
Well, it's a cash flow play. It doesn't depend on appreciation. It's really like it's not.
I see what you guys
say. Like you can juice it, right? Or not juice it depending on how good or bad you are at doing it. I mean, to some extent it's true of management in general, but much more so in Airbnb.
Okay. I think what I was also getting at is I think the baseline underwriting assumption in any real estate deal should be more of a conventional strategy, whether it's, I would say more of a conventional strategy, if it's a 2-family house, underwrite it as 2 stabilized apartments renting out on 12-month leases. And then if you think that there's opportunity to employ a strategy like Airbnb with one or both of those, maybe that's your upside case. But I think it's a super risky investing thesis to have all of your eggs in that one basket. And I think that kind of gets back to our overall investing strategy being a little bit more diversified and not having all of our eggs in that one basket.
It's a good point. And I want to be clear that most of what we look at is not for that business model. And the idea being that if it works conventionally, it's probably going to work with other means.
I mean, it's an interesting broader topic for me. We've been talking about this a lot in the context of our private equity fund, which is how to quantify risk. And I like the idea of baking in risk in an analytical model, in a numerical model in some way, but I think that's really difficult to do. So we're talking about, say, regulatory risk with Airbnb, or maybe we're talking about a risk involved with some industry being the only driver for people to live in a certain city. How do you quantify that? How do you say, well, I think there's like a 20% chance of this happening, or 10% or 100? I mean, it's hard for me to do that. And so it can be hard to build a portfolio. Say you have, you're trying to buy 10 homes and you want to have a risk adjusted, diversified kind of portfolio. I think it's really difficult to come up with the right allocation.
Well, I think the mitigant to that is on the portfolio level, and it's on the strategy side. I don't know that even the smartest quantitative minds, I think, would struggle to come up with a model that accurately depicts the risks associated with that. But I think the beauty of working in the space where we work, where our assets are smaller, and we're talking about maybe a portfolio of 100 different properties in 15 or in 10 different markets versus another fund that is working on a portfolio with a similar asset size, but that is tied to one physical property with 150 units. I think the benefit to being in our shoes is that we can diversify risk across that portfolio and say, okay, to mitigate the risk, like the regulatory risk of the Airbnb model, we're going to only allocate 15% of our portfolio to properties whose cash flow is tied to that strategy.
Right.
We're also going to mitigate risk. We're going to mitigate the risk of, let's say, Amazon HQ2's influence on our portfolio and on our returns by only limiting exposure to 10% of our portfolio in Long Island City, et cetera, et cetera, et cetera.
Yeah, I'm glad that we got here, I think, because even if you don't have the answers to these questions, I think it's fair to consider them. I think there are a lot of investors that start out and, the one mind, I'm like, don't worry about all these things because then you'll never do anything. But on the other hand, I'm like, well, don't invest in a place just because your buddy says it's a cool place to invest, right? I think because of just our level of experience and what we do professionally, we being the three of us here, are more analytical about it than I think a beginning investor should be or could be. But even having this thought process, I think is novel for a lot of investors just getting started, because they're not thinking about risk and investing theses and things like that in an area.
I think understanding risk is a difficult topic, but I think or maybe quantifying risk is next to impossible, but understanding risk is a little bit different. And I think that is a goal that every investor should strive towards prior to making a significant investment decision. And what I mean by that is you may be looking at something in New Haven, and you may be looking at something next to in another town that is heavily driven by like a smaller university. You may say, oh, like college towns are great as an overlying thesis. But I think to understand the risk of hitching your wagon to an institution like Yale versus the University of Phoenix, which is a quasi-educational institution.
No, I totally agree. I think the reason why I brought up investing in college towns, and not to go everywhere, but what I wanted to say about it was that there's a big difference in investing in a established university than a community college.
Yeah.
Even if they both might be in a college town. Not that there's anything wrong with the community college at all, but in terms of your long-term idea, is this place going to be around? I mean, I have a pretty good idea that, the second oldest university in the country that has the second largest endowment is going to be around. I don't know that about a school that was maybe started 3 years ago that has no money, that is just trying to make a quick buck or something like that.
I think it's also worth at least throwing out there the fact that maybe education down the road won't look like what it looks like today. Mm-hmm. So I think an institution like Yale is prestigious enough that they will probably find a way to stay relevant and to live on. But, if in 20, 30 years down the road, education may not take the same form that it does today. We may, I think we kind of take for granted the assumption that 4-year colleges are kind of the norm these days, but that wasn't always the case, and it may not always be the case in the future. And it's interesting to contemplate a world in which that is not the case, especially if you're hitching your wagon to investing in quote unquote college towns.
It's a really interesting point, and I want to actually touch on one thing very related, which is that there's so many things like this that are going on that our limited perspective, having invested in real estate only for a few years, can't really observe it, but one thing that always blows my mind is the influence of ride sharing, Uber and Lyft, that they have had on suburban America. I think is tremendous. I mean, it's changed a lot what it means to live in a suburb and still be able to go out and say drink or do whatever else that you maybe couldn't do if you had to drive. And imagine what, say we someday soon maybe we'll have autonomous vehicles. What might that change for people living in a suburb or people that have to commute? What if we have the Elon Musk, Hyperloop dream, or we can get from San Francisco to New York in an hour or something like that? How might that change?
I am so inspired right now.
It's funny that you brought these up because I had.
What if we could live on Mars? My God,
I had those same two thoughts running through my head as this conversation was evolving, and I don't know the extent to which either of you are familiar with like black swan theory, black swan investing, but
it's a great film.
I've actually, surprise, never seen it.
Oh my God.
But I think as human beings, we are uniquely poor at quantifying like the risk of outlier events. And there are a lot of things that in our minds are probably perceived as impossible that are really just improbable, which means there are enough of these improbabilities that eventually something is going to stick. And that's going to be something transformative. And it's going to be something that turns on its head all of these things that we take for granted, like something like a Yale falling off the face of the earth, or something like Washington, D.C. ceasing to be the political capital of the United States, right, or New York ceasing to be the most relevant city in the state or in the country.
And this is kind of a diversion from where we're going because these two are inspiring me with the words of wisdom about the future. But I do want to also address to newer investors, kind of like myself as well, and go back to a point about not necessarily being overly cautious, but understanding sort of where you're at in terms of your equity means and in terms of the amount of research and experience you have in certain areas, even looking beyond what the future holds. Because one of the things that I come back to, because I think about all of these potential changes that are going to occur in society and cities and suburbs, et cetera, which will affect markets. And I would just encourage, I think, investors, when you're identifying the geographic location you're going to just be real with yourself within your means and not to necessarily extrapolate beyond what the numbers and area and people who are on the ground are telling you, because you may believe in a lot of these things that are coming to these areas, but it's very easy to fall into the confirmation bias cycle of saying of believing a certain ARV for a flip, or believing a two-family is going to generate XYZ at market when really it's rent control or rent stabilized. And I realize this seems like a huge diversion from where we were, but I do want to get back to sort of this idea that when you're looking at some of these areas, to be that maybe that first project isn't always saying, well, this and this is going to happen, so I'm going to be super aggressive and invest in a 5,000 square foot commercial space. Staying in for example, the multifamily market might be the best idea for you as you're analyzing the geographic area that you want to invest in for the first time.
Yeah, it's all, for me, it's a risk reward sort of calculation, right? I mean, it goes back to one of the first things that we were talking about for me, which is just to define your goals. If your goal is to learn more, then that dictates where you're going to invest. If your goal is to make as much money as you humanly can, then that's a very different goal. If your goal is to make as much money as you humanly can in a year versus in 10 years versus in 100 years, that's a very different goal too.
Maybe your goal is just to house hack and not have to pay rent and get a little ancillary income on the side. And that's a different thesis that comes up depending on the
honestly,
area.
if your thesis is long, if your investing horizon is long, you can make some pretty fantastic investments. I mean, there are families in New York that have generational investing theses. So, I mean, they literally bought property in World War II that only now are they really cashing in on, and good for them. I mean, that's, that probably in 1950, buying a very large piece of land in Times Square might have been very speculative, and it probably looked like a horrible investment until,
can you imagine? Oh my God.
the Giuliani administration, let's be honest. No, it probably looked like a bad investment until pretty recently. And now it's really paid dividends. I don't know what the return on investment might be,
but it's substantial.
But it's probably a lot. So, but if your thesis is I want to do a flip and sell it in 3 months, then, don't invest in Manhattan, but I mean, there are different categories of things that you should buy.
Yeah. I think the phrase I was looking for to sort of tie in all these different points is being as a newer investor or even an intermediate investor, cautiously aggressive, both in actually allocating your capital and your equity and also how you analyze these deals.
Don't be aggressively cautious, though.
Don't be aggressive. Hold on, let me try to figure out that pretzel in my head. Don't be aggressively cautious. I like that. Yes, I agree.
Yeah.
I learn something new from these guys every day.
Yeah, I guess the way that I would frame this in my mind is before you look at a specific deal and before you decide that you're going to make an investment, first understand what you are investing in. You're investing in that market. You're investing in maybe that school system. You're investing in that economy. And it's not just, is this property going to, on paper, show that it's going to be profitable? There are a variety of inputs and there are a variety of factors that are going to contribute to whether those rents are going to stay the same over the next 20 years, whether they're going to maybe increase or decrease, whether your vacancy is going to increase or decrease or stay stable, and whether the appreciation on the property is going to be what you hope it will be, whether it's going to be stable, or whether it's, whether you're going to be stuck down the line with a property that there just aren't as many buyers for as what you were expecting.
Yeah, and I think to that point, and that's what we talked about, the fact that the three of us look at things perhaps more analytically than your most common investor, which makes sense because this is what we do for a living. But I think kind of moving into the next episode, that's where I get excited about talking with our listeners and everyday investors about both from a basic, intermediate, and expert level, what are the best ways to analyze the numbers that you're seeing in front of you? Because like we said, there are a million outside factors that affect whether or not an investment is good, both forward-looking, backward-looking, and in the present. So just sort of understanding, when we say cash on cash, when we say cap rate, not just what those means, but how to get those numbers and how that will inform your decisions after you've decided on which geographic location you want to invest in.
Yeah. And one thing, I mean, as I've said in many, many podcast episodes, not that we have very many, but something that I've said several times is I still think it's really important just to do it and get started. So what I hope people would take away from this is not that I need to be sucked into this analysis vortex of numbers and thoughts and risk and everything else, but that these are important things to consider. I don't have the answers. We don't have the answers to many of the questions that we posed, but it's important to consider them. However, at the end of the day, if you want to get started, just get started and do it. So that's how I got started, with not any of this analysis or thought process, and I've backed into it, and it's been fortunate for me. But I wouldn't have been in this position if I didn't just start.
Yeah, and I would also just think about the risk that you are taking. I think a lot of the reason why this kind of analysis paralysis or these kinds of mental models are there for quote unquote market analysis, those are in large part driven by developers who are looking at building 600 units in an area, and where at the margins, the difference between 2% population growth and 2.5% population growth are going to be the difference between whether they have enough people to live in their building or not. Right. If you're talking about a 2 or a 3 unit building in a town that's been around for hundreds of years and where there are dozens and dozens of large employers, chances are the landscape is not going to change that much. So if you've got a decent deal, which we'll discuss how to find in the next episode, you can pretty safely pull the trigger knowing that the variables that are outside of your control are likely not going to move the needle too much.
Guys, thank you for your time and your expertise as always. I appreciate it. For the folks listening at home, make sure you subscribe to us wherever you get your podcast, to reach out to us on the Brick by Brick, that's Brick X Brick Facebook, and make sure to listen to us on iTunes and Spotify. Thanks for listening.